Welcome to this Business Tax Roundup for this month. My name's Dean Wootton. First up, we've got another film scheme and the claiming of sideways loss relief. And this case concerned Robert Pole. Now, Mr. Pole set up a photography business as a sole trader using Premier Picture Sovereign. He committed $650,000 to the business. That was $125,000 of his own money, and the balance, $525,000, by way of a loan from GBF Capital Limited, a company connected with Premier Picture. Now, as a result of the way the film distribution rights were valued for accounting purposes, his accounts had a loss of £583,000 in his first accounting period. Now, in 07-08, he made a claim to carry back those losses 3 years. As a matter of interest, he also generated further losses in the following 2 years, not as much, $22,000 and $9,798. HMRC disallowed the loss claims on the basis that the film business was not a trade, or that even if it was not a commercial trade or carried on a commercial basis. Now, Mr. Pole appealed, arguing that he was carrying on a trade on a commercial basis, and furthermore, the closure notices were invalid, as there were a delay of several years before the closure notices were issued. Now, the first tier tribunal considered the notices to be valid. There's no time limit for HMRC to issue such notices. Where the taxpayer considers there is an unreasonable delay, they can apply to the tribunal for direction requiring HMRC to issue a closure notice, but it's not the other way around, which is what the case was about here in part. So it really then hinged on whether it's carried on a commercial basis, etc. Now, although he had spent some 18 hours a week on business activities, he had effectively paid out a capital sum to obtain possible future income streams, more like an investment as such. Now, with the steps pre-arranged, as a lot of these schemes are, the purchase and sale of film rights did not amount to a trade. He was not trading in film rights. Even if the business had amounted to a trade, it was not carried on a commercial basis with a reasonable expectation of profit. Consequently, his appeal was dismissed. I might be old-fashioned in this regard, but film schemes don't really interest me. And they've got to have, or any arrangement, to be honest, any scheme, they've got to have commercial basis to it. When they're a little bit artificial, circular to an extent, then I think as practitioners, we've got to be quite wary of our clients entering into such schemes. Now, the next case concerns CIS and mistakes being made under CIS and the results of those mistakes. Now, this case concerned North Point Pall Mall Limited and Chinatown Development Company Limited. Now, the appellants, let's call them NP and CT, were special purpose vehicles set up to purchase and redevelop 2 sites in Liverpool. NP and CT engaged the same subcontractor to carry out the construction works on these sites under a separate design and build contracts, and they were dated March and September 16. Those contracts identified NP and CT as the employer and the subcontractor company as the contractor. Now, NP and CT failed to take tax advice about the contracts or check them over before signing. Instead, they were just relying on experience, legal advice, quite historic legal advice, and the advice of their property agent. Now, they did not immediately register for the construction interest scheme because they did not believe they were a contractor. They subsequently realised that they probably should have done, and they registered in June 16. They then made payments to the subcontractor, assuming gross payment status applied. Now, HMRC concluded that the conditions of gross payment status were not met by the contractor at the point where the payments were first made. So therefore they issued Regulation 13 determinations. Now, North Point had its determination of $663,000 for 15-16 and $667,000 for 16-17. Chinatown, not as bad, $98,000 for 15-16 and $293,000 for 16-17. Now, NP and CT appealed. Now, they appealed on the basis that they had taken reasonable care, and the failure to deduct was due to an error made in good faith. They held a genuine belief that the legislation requiring deductions to be made did not apply in this situation. They therefore had been overcharged and should either be absolved of liability under Regulation 9.3 as they had taken reasonable care, or the assessment should be discharged under Section 50, Para 6 of the TMA 1970. So this went to the first tier. Now, first tier decided the error was made in good faith, but that did not amount to taking reasonable care. Now, given the amounts and complexities involved and the potential consequences of getting it wrong, the appellants should not have just signed the contract without checking them with their accountants, for argument's sake. A reasonable director would have challenged the advice of their property agent rather than taking it at face value. But to my mind, who would you rather trust, a property agent or your accountants? I think for this type of thing, you'd be going to your accountants and asking them. Now, they tested the advice against their own experience, and they should have taken independent advice from a tax expert, but they didn't. A reasonable director would have done that. They would have challenged the advice. They would have tested the advice against their own experience. I mean, they were using their own experience in this regard. But I think the first point and the third point, taking independent tax advice from an expert, it really shot them in the foot. A reasonable director would have done that. They did not. So the first tier tribunal dismissed the appeal. The appellants had failed to take reasonable care. Furthermore, the first tier said that once a determination had been made under Regulation 13, it is too late for either HMRC or the tribunal to be able to grant relief under Regulation 9.3 and direct that the contractor is not liable to pay the amounts that they have failed to deduct. HMRC guidance directs that relief under Regulation 9.3 must have already been considered by HMRC before a Regulation 13 determination is made. If, however, the first two are wrong, the judge said that the failure to take reasonable care meant that the appeal would still be dismissed. So CIS, high risk area, even with the new domestic reverse charge, if we have got gross pay, if we think gross pay status is there, then due diligence should be applied, as they should talk to us, their accountants, and the valid checks should be made, or relevant checks should be made. You don't just assume something, especially with the numbers involved here. It's just too risky. You've got to do proper checks under the CIS. A little bit on the OECD model reporting rules for digital platforms. Now, from January 23, platforms will need to report information about the income of sellers providing goods and services, so something they need to get ready for. Now, broadly, the OECD model requires platforms to collect details about their sellers, including information to identify who the seller is and where they are based, and report the information, including the seller's income, to the tax authority annually by the 31st of January. Platforms must also give the information to the sellers so they can use it to help them complete their tax returns. Tax authorities will then exchange information with other tax authorities where the sellers are relevant. The government is consulting on the implementation of these reporting rules, and that consultation does set out details of the rules and invites views on the optional elements and the UK's proposed implementation of these requirements. I'm going to look at some VAT. So we've got the flat rate scheme first up. Now, Mr. and Mrs. Turner were equal directors and shareholders of Trans Wales Trails Limited, so a company. Now, TWT, that's Trans Wales Trails Limited, ran a horse riding holiday business and accounted VAT under the flat rate scheme, so no problem there. They acquired a farm with a cottage plus 2 flats to convert into accommodation to be used by the horse riding business customers in the summer and as a B&B accommodation in the winter. Now, the construction work by 2 builders was invoiced to TWT, the company, and they reclaimed the VAT. Now, remember, they're under the flat rate scheme. So consequently, HMRC denied the claim as the input tax did not relate to capital goods over £2,000. They regarded it as services. Now, recognising this is a problem, the individuals, Mr. and Mrs. Turner, then registered the guest accommodation business and reclaimed the VAT. HMRC disallowed that claim as there was no valid invoice. The invoice was made out to the company. It's no good forming a partnership and trying to recover in the partnership when the invoice is made out to the company. Now, the partnership appealed to the first tier tribunal. They appealed on the basis that the costs, the input tax, related to the partnership activities should be recoverable. HMRC stated that the services had been supplied to the company, and only the company could reclaim the VAT, which they couldn't because they were using the flat rate scheme. Now, First Tier Tribunal decided that the partnership did not have a valid VAT invoice, nor could it provide alternative evidence of the supply being made to it. The supply of services had been made to the company's in the flat rate scheme, there was no deduction. The case was dismissed. Now, in hindsight, they could easily have got this, but I think it's obviously happened, and the accountants come along later trying to sort it out for their clients who probably didn't speak to them. So easily avoided in the first instance. They should have gone to the accountants. The accountant said, look, if it's billed to the company, you can't recover. Let's set up a partnership, get the partnership registered properly, and then you can recover. So very easily done had they identified the issues up front. So a quick look at postal charges. And this is a test case, and there's something like 500 upwards £1 million at stake on this. Now, in this particular case, ZipFit Limited supplies vitamins and minerals by mail order, and they use individually negotiated contracts with the Royal Mail. Now, under Article 1321A of the Vat Directive, and that leads through to Schedule 9, Group 3, Para 1 of the UK legislation, the VAT Act 94, postal services are exempt. But following TNT Post, the exemption does not apply to suppliers of services where terms are individually negotiated as they were here. Such services should be standard rated. So the Post Office should have charged VAT to the likes of ZipFit. Now, ZipFit sought to recover the uncharged input tax from HMRC. The claim was disallowed on the basis that ZipFit did not pay any VAT. Now, prior to Brexit, the Supreme Court requested a preliminary ruling from the Ecj, which is the subject of this case. And the Ecj pretty much stuck to fundamentals. And to be able to reclaim input tax, you must hold an invoice. And that invoice must separately state the amount of VAT being charged. As ZipFit was not in possession of a valid VAT invoice, they could not recover the services. So whilst this is obviously a rather large case, the fundamentals are there. You cannot recover VAT without a VAT invoice. As ZipFit did not have a VAT invoice, they could not recover VAT. Whether they're going to go back to the post office, etc., unclear. This is more a case of can you recover VAT without receiving a VAT invoice? And it's held that you cannot. Let's look at a best judgment case. Now, this concerned Kingsley Douglas, and he was a sole trader running a business selling cigarettes, tobacco, newspapers, and he was almost permanently in a VAT repayment position. Now, following inquiry, HMRC issued best judgment assessments totalling £140,000, primarily on the basis that his records were not complete. For example, he didn't have any till rolls for his business. Alarm bells would obviously ring there. Now, First Tier Tribunal agreed with HMRC's best judgment assessments. Full records weren't available, and they had done the best with what was available to raise these assessments. Kingsley Douglas appealed to the Upper Tribunal. Now, the Upper Tribunal decided the reliability of Mr. Douglas's records was, the most important thing, and the First Tier had clearly considered all the evidence in the round. It was not for the Upper Tribunal to interfere with the First Tier's evaluation. They're taking all the evidence into consideration, so why should the Upper Tribunal say otherwise? The appeal was dismissed. The £140,000 was due because of rather shoddy records, i.e. no till rolls. The next case considers Cmj Aberdeen Limited, and it's a land and property case. Now, Cmj Aberdeen is a joinery and construction services company. Now, they were working on a job, and in June 2012, planning application was originally made for the demolition of an existing dwelling and garage and the reinstatement with new build dwelling and garage. Now, that would be a zero-rated contract, that one. But to gain approval, it was amended to be an extension and a garage with a newly designed dwelling house retaining 2 of the original walls. That would have been a standard rated contract. Now, in February 13, The original walls were discovered to be unsuitable, and so they were demolished and rebuilt. In November 14, the council granted full planning permission for demolition of existing steading and erection of new dwelling house. It was retrospective, the planning permission. So the issue at stake was Schedule 8, Group 5 of the VAT Act as the zero rating for construction service relating to a new dwelling. And one of the conditions to be a dwelling is it must have statutory planning consent before the work starts. In this case, the planning permission was retrospective. So therefore, HMRC raised an assessment saying, well, you should have standard rated the job, not zero rated it. Then the first tier tribunal agreed with HMRC, and you can't really see them having any other alternative because the law is the law. So planning permission wasn't granted at the time the work was done. So unfortunately, zero rating was not in point. The job should have been standard rated. Land and property, very tricky area. You've got to hit the conditions. There are 4 conditions to be a dwelling, and unfortunately, one of them is planning permission. They didn't have that, so that's a standard rated job. This case concerns black cabs. So the Black Cab Service Limited leases London Hackney cabs to self-employed drivers. It saves the drivers the aggravation of maintaining the cabs, etc. Now, the black cabs are insured under a motor fleet policy taken out by the company, and they get a very good arrangement, very good deal. Now, the drivers have the option of using their own insurance. They could just pay for the lease, but they were paying for the lease and insurance, but they could take out their insurance if they wanted to. But the drivers never used their own insurance policies. The agreements that the company negotiated with the insurance company was very good. So why wouldn't they go with the block policy? The insurance was £30, but no invoices were ever issued to the drivers. They were just receipts with insurance set out separately from the finance and maintenance charge. Now, the insurance was treated as a taxable supply originally, but the company later claimed that it was a mixed supply and the insurance element was a standalone supply and should have been exempt. And they submitted an error correction for £43,000. HMRC refused the claim. Now, the first tier considered drivers were always given the option of using their own insurance. The drivers were aware of the added cost of insurance. It was set out in the agreement, and they had saw the receipt, which did show the hire and insurance separate. Now, the average driver was likely to conclude that Black Cabs Limited supplied 2 things. They supplied the vehicle and exempt insurance of that vehicle. So therefore, HMRC was wrong to deny the repayment claim, and the appeal was allowed. You wonder whether this will just trickle on to look at insurance premium tax, so IPT. So there wasn't any VAT, but maybe there's an IPT angle to this. Last up, let's look at a subsidy case and just see the impact of subsidies. This concerned Colin Newell. Now, Colin Newell traded as a hot air generating business, and he received periodic support payments, subsidies, under the Renewable Heat Incentive Scheme. Now, both parties accepted these support payments were outside the scope of VAT. Now, HMRC determined that his input tax should be reduced, i.e. apportioned between the taxable activity that he mainly did and the outside the scope supplies, the subsidies, and they raised assessments on that basis. Colin Newell appealed, arguing that there was no need to restrict his input tax recovery because he had made no exempt supplies. He only made taxable supplies. Now, the first tier considered 5 historic cases heard by the ECJ. Now, the question, is there an activity taking place that generates a subsidy income, or is the business only involved in making taxable business supplies? And that's been in the ECJ on a number of occasions. Now, there was a direct immediate link between the purchases and the taxable supplies. The fact that the business might not be viable without the subsidies was irrelevant. The appeal was allowed. And it's quite consistent, to be honest, with decisions in this area. Just because you have subsidies doesn't make input tax of your business partly non-deductible. Our friend Neil Warren commented on this, and his comments are fair, straight to the point. HMRC has always accepted that an activity can be either business or non-business, but not both. Non-business income, for example, grant income, can be used to support business activity. This does not mean that the supported business activities becomes partly non-business and partly business. Using non-business income simply makes them subsidised business activities. So essentially, the subsidies do not affect the input tax recovery on what is essentially a taxable business. Yes, they receive subsidies to help them in their taxable activity, but the subsidies should not restrict the input tax recovery. Well, that concludes the business tax roundup for this month. My name's Dean Wooten. Thank you for listening.